Hi, this is Dr. Tom Gerard, and we're in the middle of our Introduction to Financial Accounting course. And in this section, we're going to introduce the idea of accounting for long-term fixed assets. And we have to be able to define what a fixed asset is, classify fixed assets, and account for the cost of the fixed assets. We'll also discuss the three different main methods used for depreciation of those fixed assets. All right, here we go. We're going to talk about long-term fixed assets, sometimes called capital assets. And we're going to be talking about, well, first of all, we're going to have to define, classify, and account for the cost of fixed assets. So bear with me because this can be a little bit detailed, just like most of the stuff in the Introduction to Financial Accounting class, especially when we start talking about the second part, which is the different methods of depreciation. So first of all, let's talk about fixed assets. So these are physical, they're tangible, they're typically they're used, they're things like your and we'll see some examples here in just a second, buildings, equipment, machinery, vehicles. And because sometimes they're called capital assets or fixed assets, we think of fixed as something that's fixed, it doesn't move, but it could be like a big dump truck or types of equipment that lasts a long time and that they do move, right? Okay, they're owned and they're used under normal operating conditions. So we'll get into that here a little bit more in a second. And they're not used normally for sale. So in other words, it's not like an inventory item that I'm going to buy a truck and then turn around and sell it. I'm using that vehicle for the purposes of running the business. So they're long-term, they're permanent machinery, and again, equipment, buildings, land, other descriptive titles that you might see out there is property, plant, and equipment. If you may even go to work somewhere and you'll hear people say PP&E, PP&E, you know, accountants and everybody else has always got their little acronyms that they like to use, and PP&E is one of them, but it stands for property, plant, and equipment. And typically they're talking about fixed assets when they use that term, PP&E. Okay, the cost that's been incurred may be classified as one of three things. Okay, so now any cost, so think about this, any cost that you incur is a fixed asset, which is what we're talking about in this chapter, an investment, or an expense. Okay, so we're trying to distinguish whether or not when we purchase something or we spent money on something or a cost that the company incurs, is it a fixed asset, is it an asset, or do we expend it? Now, I'm going to tell you, we're going to follow what typically this is from an entry-level financial accounting book that we're sharing this from. But, you know, in the real world, there is discrepancies. There is discrepancies on some of these things. And a fixed asset accountant is a very valuable person. They are specifically trained in identifying and accounting for fixed assets. So we talk a lot about that in this introductory course. You're not a full-fledged accountant in any specific area because you took an introduction to accounting course, right? Accountants are just like a lot of other professions, whether you're an attorney or a doctor or any of these professional positions, you specialize in a specific area. Maybe it's in accounting, maybe it's taxes, maybe it's payroll, maybe it's financial reporting and doing the financial statements. But a fixed asset accountant, I guess what I'm saying is a valuable person to have on your team because they really understand this stuff in a little deeper level, because there is discrepancies and your book doesn't always like to tell you that, but in the real world you will find people that disagree among highly trained CPAs and others that you're trying to determine do we expend this or is it a fixed asset? So first of all, number one, is it a long-lived item? And long life in accounting, remember, is over a year. So are we going to have this asset for more than a year? If so, it's typically a fixed asset. Now, however, is it used, number two, is it used in normal operations? Because sometimes we have something that we purchased and we don't use it in normal operations. So here's a little diagram. Is it long-lived? No. If it doesn't, something that's not going to be kept in the company to generate revenue or contribute value to the organization for more than 1 year, then it's an expense. And you'll see here is an expense. So not long-lived, expense, right? Now, like I said, there's some disagreement on these things, which I might talk about a little bit here so you get an understanding of where I'm going with that. But I don't want to confuse you. If it's less than a year, expense. Number two, is it used in normal operations? Okay, first, number two is yes, it is long-lived, right? We're going to use it for more than a year. If it's yes, then the second question is, do we use it in normal operations or not? And you'll see here in this situation, on the little diagram, it says, yes, it's a fixed asset because we use it in normal operations. In other words, we've bought the dump truck to haul dirt for our company, or we've got a lawnmower that we're going to use to mow lawns with, right? A $10,000, $15,000 zero-turn lawnmower, right? We're going to use that. Now, what happens if we bought an asset that's going to have value for long term, but we're not using it in operations? And this happens all the time. And then we're going to call that an investment, right? Sometimes a company will buy a piece of land. They're not using that land necessarily for their ordinary operations of the business, but they may use it in the future, or maybe they'll just turn around and sell it in the future. They're looking for an appreciation of that asset. That's an investment. Okay. So again, land, buildings, or equipment, they last more than a year. They're used in normal operations. Again, it's repetitive, what we've been talking about. And so the next thing is only the cost necessary to prepare, or I should say, the book says only the cost, but what we need to say is all the costs that's necessary for preparing the fixed asset to be used is something that we can attach to the cost. Okay, so and in this case, they're talking about things that are not to be included. Only costs necessary for preparing, and what they give you here is some examples of costs to not include. In other words, say we're building a building and we have wood or things that's going to be in the building. In that building, when we're finished with it, sitting out, you'll see here, it gets vandalized, it gets stolen, uninsured theft, right? Vandalism. How about mistakes in installation? You know, I can tell you a story of everything that we talk about, basically, that I've had experience with in the real world. But for example, there was mistakes in installation, and so we were building a building, and the painters came in and they painted the inside of the building. And when the person that was over that project came in, they said, well, you used the wrong color, right? So the painter says, well, if we, and they said, you have to repaint it. And the painter says, well, that's going to require a bunch more paint. And so where I'm going with this is, it was a mistake. You cannot depreciate the value of the paint more than once, right? If the paint costs, you know, $5,000 or whatever for a building, you can only account for that once. You can't say, well, we painted it, we made a mistake, and now it's $10,000, not $5,000. So anyway, that's what they're talking about when it says I made a mistake. Damage during unpacking and installation, right? Sometimes you get a piece of equipment delivered and it's been damaged, and then, you know, you have to fix that damage, right? Well, that would be an expense if you're going to keep that, and the firm is actually paying for replacement, or fixing it, I should say. Fines for not obtaining proper permits in government agencies. Now, the truth is if you do pay for permits and things of this nature, you're entitled to that. In fact, let's go back up here. Here's some things that the cost of acquiring a fixed asset. For a building, architects, engineering fees, insurances while it's been construction, sales taxes, repairs, all of these are things that are included in the cost of the building. And you might say, well, that makes complete sense. But remember that there is, say I'm building a building, and when that building is finished, we're going to grab all of these costs that went into building it. But the question becomes let's say we had to have electricity or water on for the contractors. Well, do we expend that electricity or the water? Because, in normal operations of a building, we don't depreciate the cost of water or electricity. That's an expense. So there is a situation where, under some circumstances, I've seen it where they would say, well, during construction, because it's part of building the building, you got to be able to power the saws and stuff, that we could actually depreciate the cost of the electricity, which normally that would be an expense, right? So here's a machinery and equipment. Taxes, freight, installation, right? If you buy something and have to have it installed, and it costs, part of having that piece of equipment installed could be depreciable cost. We're trying to build a cost pool is what we're doing. We're building a cost of what goes into this fixed asset, right? Insurance while in transit. Again, insurance would typically be an expense, not a fixed asset cost in their general terms. But in this case, because we're putting this asset into service, assembly, modifying, testing for use. Now, let's talk about land for a minute, because we don't typically depreciate land, but we could call it a fixed asset because it is a fixed asset. What is the value of this land? Well, the purchase price of the land, but sales tax, permits, brokers' commissions, titles, fees, all of these things, if we were going to, now in the case of land and all these other things too, but we're not going to depreciate land because land has doesn't expense, we'll get into that here in a minute, but basically land doesn't lose its value. If you have a piece of land, I live in Oklahoma, I build a building on the piece of land and a tornado blows the building away, the land value in essence hasn't changed. What we're talking about, as far as land goes, is how do we put the value of this piece of land. Now, what about land improvement? Trees, fences, outdoor lighting, etc., right? We're going to put value on this. Okay, that's what this is: cost of acquiring and putting it in place. Okay, all costs necessary for putting it in use. Things that we don't use. We've already talked about that. And so right now they introduced this concept of lease. And they do that because we're classifying costs. Is it a fixed asset that we, as the owner of the company, incur that and we're going to depreciate over a period of time, or are we going to expend it? And remember our little chart we just looked at a minute. Now think about a lease. A lease is a contract for the use of an asset, right? You go lease a vehicle, you're allowed to use the vehicle. The two parties to a lease are the lessor and the leasee, and the lessor is the person who owns the asset, and the leasee is the party to whom the rights belong, the person who's going to be able to use that asset. Now, the thing is as a leasee, I have this piece of equipment maybe, or this building that I'm using like in rent, or I've leased a piece of property, but the property doesn't belong to me. I cannot depreciate the building because it doesn't belong to me. It belongs to someone else. And so therefore, really where they're going with this is that a lease is an expense. You pay the lease for the time period that you are under contract. Okay? Now, companies do lease for certain purposes, and this is one of the showing the advantages of lease in this particular slide. The leasee has access to the asset without having to spend funds or obtain financing to buy the asset. So if I bought a $1 million piece of medical equipment, let's say, for the hospital, it would cost me millions of dollars. I'd have to finance it. I would have that equipment, and then I'd have to deal with maintaining the equipment. I'd have to be able to sell that equipment or get rid of it when it becomes obsolete. And that's kind of what they're going with here. The repair costs may be incurred by the owner and not the leasee, but the lessor. Sometimes you'll see vehicles that you might lease, and they come with, free oil changes for the time that you have the lease, right? Well, that's because they get that car back. When the lease is over, they want to get that car back, and they want to make sure that it's maintained properly so they can turn around and sell it or whatever they're going to do with it. The risk of incurring additional costs because the asset becomes obsolete. We just talked about medical equipment. Think about computers, things like that. If we buy a computer and in 3 years it's obsolete, now it's about 3 years, or it used to be 5 years. Now it's becoming less and less time that computers are and all kinds of technology. But if I have to keep replacing, buying more, put them in service, and then turn around and sell them, figure out what I'm going to do with these old ones, that is a lot of expense on a company. Not to mention the fact if something goes wrong with them, who covers the cost of repairing them? Sometimes if we're going to lease this equipment, the repair is part of the lease, right? They're part of the agreement. And I don't have to worry about whether it's obsolete because I get a new one every, 2 or 3 years, whatever the contract is for. So there is advantages. And they kind of throw that here in this chapter because we're talking about, is it an expense or is it a depreciable long-term asset, right? Fixed asset. And a lease item is not, because you don't own it. Now, there's gray area. I don't want to spend too much more time on this because, I could go on and on, right? Okay, so over time, fixed assets, with the exception of land, lose their ability to provide services. Now, we're going to start talking about depreciation. We want to take the fixed asset, such as the equipment or the buildings, and record them as an expense over the useful life of that particular asset. So now, the first thing I know we would have talked about depreciation. So recording the cost of fixed asset is called depreciation, and we've talked about that in a previous time. And one of the things, like I say when I'm teaching my introductory courses to accounting, is people have things in their mind when they think of a word. And remember, we talked about debits and credits and how people think credit's good or credit's bad, right? It's not good or bad. And depreciation is one of those words that ordinary people use the word depreciation. And sometimes they use it consistent with the way accountants use the word depreciation, and other times they don't. And in most cases, people are talking about in the real world, not accountants. They're talking about the market value of an asset. So in other words, I bought a new car, brand new car. They always say, oh, I bought a new car. I drove it off the lot and it depreciated overnight. Well, that may be true. The value of the car may have went down. But there could be a situation where you bought something and you paid X amount of dollars for it, and the value actually went up. So that's the opposite of depreciation. So in the market value, in the other world that we're not talking about accounting, depreciation has a little bit of a different terminology, because we're talking about an expense called depreciation that we're going to put on our books. Right, and we talked about this when we talked about that adjusting entries back several chapters ago. The adjusting entry for depreciation expense. Okay, it has a limited life. Land, because land has an unlimited life. It's not depreciated. Kind of like I just said about the tornado. The land is supposedly still worth whatever we paid for it. Now remember, we're not talking about the market value. Land changes market value, depends on a lot of different factors, but we're not talking about that. We're talking about I paid X amount of dollars for the land. I paid all of those things to put that land into service, and that's the value of the land, right? Not what's the market value. Okay. Depreciation can be caused by physical or functional factors. Physical, wear and tear. Functional includes obsolescence, like we talked about with the computers, or changes in customer needs. The asset no longer has its value, right? So this is really, again, a little bit deceptive, because we're going to depreciate the asset independent of market value, right? So don't get it confused with market value. I talk about the pickup truck. Maybe I bought a brand new pickup truck, and yes, I've taken it out and I'm using it to do work in it, and yeah, it loses its value because I'm using the truck. But what happens if I would have bought a truck that was a 1957, Ford or Chevy, and it's really going to go up in value, right? I paid X amount of dollars, and I'm going to expend that cost, and I'm using it for my business, by the way, not just on the weekends. It's my business truck, but it's an old classic truck, and that classic truck, even though I'm using it and for my business, and it may physically depreciate because you got to fix it all the time, but in reality, the market value is going up. We're not talking about that. My depreciation is based upon what I pay for it. And sometimes you get a deal where you pay less than market value for something. That's what you have to depreciate it based upon, what you pay, not what you think it's worth, right? Oh, I got a really good deal on this old 57 Chevy, right? But in reality, you're not depreciating what it would be market worth. It's what you paid, right? So think about that. And this is where they're talking misunderstandings, right? Depreciation does not measure a decline in the market value. And so we talked about that a little bit here now, enough. And so the next thing is depreciation is an allocation of the fixed asset cost over the useful life. The book value is the cost less accumulated depreciation. Remember back we talked about that accumulated depreciation account that we add. We don't just change the value of the account that's called the depreciation account, which would be that particular asset. We add a contra account, which is an offsetting account. We call it a contra account, and that's accumulated depreciation. And that's important to know as we look at the different depreciation methods in the next section. Depreciation does not provide cash to replace the fixed asset. So even though we have an expense, it's not a cash expense. We're not writing a check or sending money for depreciation. So it's not going to provide cash to replace it at the end of the time. It is an expense on our income statement, but it's not going to be like cash is going out of the bank. And that's when we get to the section in the future when we start talking about the statement of cash flows. We have to adjust for that. So our income statement and our statement of cash flows are going to be different because in the income statement we're writing something off as an expense, but in the cash statement of cash flow, there's no cash leaving the business, right, for the depreciation expense. Don't get that confused with maybe I'm making a payment to the bank because I borrowed money to buy this truck, right? That's a different thing, okay? So three things are important in computing the depreciation expense: the initial cost, the useful life, and the residual value. So the initial cost is what we paid. And again, go back to what I said about the truck. It could be a brand new truck that I paid full price right off the lot of the car dealership, or it could be an old truck that maybe is worth way more money than what it sold for when it was brand new. But even at that, maybe the truck sold for $3,000 in the 50s, and now it's worth $100,000, and I only paid $50,000. I got a good deal. What it was sold for originally and what it's worth on the market are irrelevant. It's what did I pay? What was the purchase price for this asset? Okay, useful life. How long are we going to use it? Now, there are standards in place that we typically use. I'm not really going to get into that right now, but we'll see when in our next video on the three different methods of depreciation how we how we would look at that. It is estimated at the time of the asset. Now it's an estimate, right? And again, you might have an estimate of an example. Those big dump trucks that we talk about, I was talking about, maybe that's something that you depreciate over 5 or 10 years, but you might use that truck for 20 years. Think about airplanes. Airplanes, most of the airplanes that you're flying in or that people own are many years old, many years old, but we're buying them and we depreciate it over a certain period of time, but you still use that. And then you have to estimate what it might be worth at the end. I think that's my next slide. The residual value. Residual means what's it going to be worth when I'm finished with it, right? When I'm done with the depreciation, it has a value. So my truck, I'm going to use it for 5 years and I'm going to turn around and I'm going to sell it. What can I get for it in 5 years? Even if I've used it every day to go out and haul junk in it or whatever, right? And we call that the salvage value, scrap value, there's trade-in value. A trade-in value is more the normal term that most people are familiar with when you're talking about a vehicle. But in the accounting, I typically have seen that we talk about the salvage value. What is it worth? And salvage, don't get it confused with like the salvage yard where you're going to completely junk it, but the salvage value, because it could be something like a multi-million-dollar MRI machine or something, that we've used it at our hospital and we've used it for a life. New machines come out, more modern, more technology. We have now. We're going to buy the new machine, and then the other one we sell off to a different hospital that maybe can't afford the new one, right? The newest technology, but yet still functional for many years. Okay. The difference between a fixed asset's initial cost and a residual value is the depreciable cost. This is what we're going to talk about when we say, how are we going to depreciate this asset? What is the cost going to be? Well, the depreciable cost is the initial cost, which includes all of that stuff we talked about before. Put it in service, the delivery, the installation, any of those things. All of those costs minus what it's worth when we're finished with it. That's the depreciable cost. Now, some things have no residual value, no salvage value at all. We use it till we're done, right? And it's no good anymore. And that's the useful life that's this expense, the use of it over the useful life. We're going to use this asset, our depreciable cost, and how long are we going to use it? Say 5 years, 10 years. Now maybe it says useful life. Again, deceptive terms here because I might depreciate it over 5 years, but I'm going to use it for 10, right? I have let's say I have an airplane that we're using, and it's already a 1985 Cessna, and I've bought it, and now we're going to use it for 5 years. We're going to depreciate it for 5 or 10 years. But even after 10 years, that we're still going to use that plane, right? Okay, so here's an example of what we're talking about: the depreciated expense. A new forklift, they bought it for $24,000. It's going to be used for 5 years, or the useful life, I should say, for accounting purposes. And then the residual value is $2,000. Now, we're going to start talking about the different methods, and I'm going to go to another video for that because we've already gone, close to 30 minutes on this one. So we'll see you in the next video.